Welcome to the Big Skinny with me, Lou Basenese, coming to you from the mile-high city of Denver. Always on the move, always on the go, but we're always here Mondays at 5 p.m. Eastern. If this is your first time joining us, you might be wondering, what the hell is this Big Skinny all about? Well, let me tell you, it's all filling no fluff for the financial news markets. Some guests have called us the sports center of financial news. I'll take it. If you look in the Urban Dictionary, the Big Skinny is insider information. We're not that, but we are the most essential truths to help you sort through the noise. Again, all filling no fluff, no more intros needed for that. Each week we bring it to you in our rundown, and we bring you some compelling guests to help us understand and sort through the noise in the markets. And this week, I'm extremely excited to tell you about us three battle-tested veterans, even though one of them might be young. He's a pro. The first guest of ours is going to be Cade Bergmann, the co-owner of Wolf Bitcoin. He's going to educate us more on crypto because this old guy knows it's a young guys and girls game in the crypto world, and they got up to speed way faster than us, and we're trying to play catch up. Looking forward to that conversation right out of the gate. We're going to follow that up with a fellow Fox business commentator, David Nicholas, the head and president of Nicholas Wealth Management, who's got a very innovative ETF that he launched that I'm going to tell you all about. Generates weekly income, folks, in a definite tech-focused way. So I don't think there's anything else out there like it. And we're rounding out this episode with our third and final, but not the least guest, my boy, Kenny Polcari, the fellow Italian that loves to cook it up. So we're going to see what's cooking with Kenny. We're covering tech darling, small cap value plays, crypto moonshots, and the best way to sort through it all this week. Remember, you can join the conversation at any time. We're streaming live on multiple social platforms, so don't be afraid to get your keyboard courage going. Fire away. There's no question, comment too offensive, probably some that are challenging. We welcome them. So let's get rolling with this week's rundown. Well, the punches are being thrown this week in this week's rundown. We're bringing up headlines where Wall Street seems to have just a monopoly on these fear trades. I mean, we're talking tech bubbles, small caps, and maybe are they a big trap? And a crypto bust, is it coming? I don't know. We're going to take on and tackle those topics in this week's rundown. First, coming at you with tech bubbles, you get these warnings, these headlines saying, look, the AI bubble is going to be worse than the dot-com implosion. That valuations are getting way too far ahead of themselves, and you better batten down the hatches because portfolios are going to get blown up. Now, do you believe that? I don't. Even though it's coming from an economist I respect, Torsten Slok over at Apollo Management, as he shares in his note, AI is going to have a significant impact on our lives and productivity, but there's always a but with these economists. That doesn't mean that the tech companies in the S&P 500 are correctly priced. So what in the world is he talking about? Well, no doubt you've seen it in other headlines, heard it on other news programs. The fear and loathing that tech companies make up a huge percentage of the S&P 500, that their prices are just running away with the index. And if you didn't know this, the S&P 500 is weighted based upon market cap. So as these big companies get bigger, they have a bigger influence on the price of this index. And here you see it. Compare the dot-com days to nowadays, and it looks like it's tracking perfectly. It looks like it's perfectly correlated, meaning a correlation of one. These things move in lockstep. If one's going up, the other one's going up. What? Correlation does not equal causation, right? This is not just necessarily a runaway dot-com bubble 2.0. How do we look at this? Well, look, I'll give credence to the fact that things are getting expensive. If we just look at the top 100 companies in the S&P 500, so the S&P 100, the majority are, almost, 27% are trading above a 50 times PE ratio. That's expensive, folks. That's really expensive. If we go back to the dot-com days, things peaked when those companies were trading north of 90 times earnings. So if you look at the stratification here, there's not many stocks in the S&P 100 that are cheap. That's fair. The cheapest one that's trading at less than 10 times earnings, don't touch it with a 10-foot pole or anyone else's money. It's Comcast. I wouldn't go after it. But how can we bring about some, I don't know, clarity when everything's so expensive? Well, I tell you, first and foremost, stop worrying about a bear market and a blow up. They're short lived in nature. We've shared this before in one of our money charts. The green are bull markets. The red, if that are barely perceptible here, are bear markets. They're fast and furious, but they're over. And that's the key. So, yeah, I'm not saying the bear market's not possible. We had a itty bitty tiny super small one this year, and it's long gone. And now we're back to all-time highs after Liberation Day. So what should we focus on here when it comes to the AI trade? Well, no whammies, no whammies. Stop. If you ever remember the game show, press your luck. Look at earnings. We say this here. It's a fundamental truth at the big skinny. Stock prices ultimately follow earnings. And if we look at the estimates for the S&P 500 over the next 12, 24, and 36 months, you see the trend is extremely clear. Earnings growth is going higher from here, and it's accelerating. If you look at some of the big tech names that are in the S&P 500, that earnings growth rate is going to get faster, not slower. Microsoft, Amazon, Alphabet, all Meta, all ramping up. Microsoft, for example, going to have 13% earnings growth this year. Now, remember, that's a multi-trillion-dollar market cap company with double-digit earnings growth, going from 13% to 17% to 19%. Here you have it, folks. This is going to drive prices higher. So I said this in the last week on mainstream media that I would rather things be overpriced and keep running and be in the market than them be overpriced and me be afraid and be out of the market. So the investment insight is stay invested, stay nimble, and keep looking for opportunity, which we're here to bring them to you. That rounds out the first thing in the rundown. What's next? Well, small caps, big trap. Yeah, if you listen to Trading Pub, the warning is that hedge funds are shorting small caps at record levels, and that means they're the smart money. We should just follow the smart money. The brightest kid in class, just do what they do. Jump off the bridge in small caps, do it. No, don't do it. Short bets against small caps, which we brought up on the show before, are at a record high. They've nearly doubled since the last time we looked at them, up to $20 billion. Well, folks, I got news for you. I've shared this before. I'm a contrarian at heart, not because I like to be different, because you're either a contrarian or a victim in the markets. And you got to be paying attention to extreme sentiments. And Humphrey B. Neal said it best in his book, The Art of Contrarian Thinking. If you've never read it, I strongly encourage you to get it on Amazon. No affiliate link included here. But he says when everyone thinks alike, everyone is likely to be wrong. And I'm telling you, these hedge funds are going to be dead wrong about small caps. They're rallying a lot stronger than they have before. If you go back to last week's action, small caps had monster moves after the CPI print. And here's what's most important. Small cap earnings growth is going to be a lot faster than large caps. If you compare the Russell 1000 to the Russell 2000, so the Russell 1000 is the 1,000 largest companies in the US. The Russell 2000 is the 2,000 smallest. And if you look at it based on value or growth, it doesn't matter any way you slice it and dice it. Over the next 2 years, small cap earnings growth is expected to be much faster than large caps, which suggests small caps are going to have a massive rally, and it's going to be fueled by all these short bets too in the short term. I would ask you, if you haven't, and if you don't remember this far back, go back to the 2009 low, go back to the 2020 COVID low. Guess what ran the fastest and farthest? It was small and microcap. So if you're not positioned early, you're going to miss out on some of the biggest moves. So hedge funds, bring on the haterade. I don't care. You're setting the stage for us, Main Street, dumb money investors, to make a lot of money in Russell 2000 names. Rounding out the list is really what is most important and top of mind for me this week. And that's really, are we in a crypto boom, and is a bust right around the corner? I mean, this is hitting mainstream news here, CBS News. Is cryptocurrency the next big boom or the next big bust? Could it be both? Here's my point. It's now going on to mainstream news, so that's obviously a conversation that's out there. And if we look, here's what I want to tell you. Just because it's in the news doesn't mean it's in everyone's portfolio. The fact is, as Tom Lee of Fundstrat points out, that 95% of investors have zero exposure to cryptocurrencies in their portfolios right now. So that means we're still way early in this trend. I mean, if he tries to liken it back to the days of the dot-com boom, we're still in 1996. And we had 4 years of running in that dot-com boom before we neared the bust. So I think we have at least that much runway. And, look, I'll concede that there's a tremendous new interest in cryptocurrency. If you look at the number of companies that are saying we're not going to just hold cash anymore. We're going to hold cryptocurrencies. It's ballooned in the, guess 8 months this year so far. 92 companies by this tally that have launched a crypto treasury strategy, meaning they're holding not just cash anymore, but they're primarily holding a cryptocurrency. So Bitcoin topping the list with 33 such companies, and you see Solana and Ethereum. Obviously, Ethereum is coming out much stronger, coming back. A lot more companies announcing that now. But here's where I really want you to focus. Wrestle with this reality that over 75% of professional money managers still have absolutely zero allocation to Bitcoin and to cryptocurrencies. You got that right. So not only is not Main Street mainly invested in this, Wall Street's still largely underinvested in crypto. And that means this boom can continue a lot longer than anyone can anticipate. And we're going to cover that topic next with our first guest. But first, I want to remind you, join the conversation live. Sign up for our newsletter at thebigskinny.com, scan the QR code on your screen, and make sure you get all the news and information and market moving insights to help you increase your bottom line. Take a pause right after this. Do you believe everyone deserves access to quality healthcare regardless of their financial situation? Well, at the Roberto Clemente Health Clinic, we make that a reality. We're a US based 501c3 nonprofit, and I say we because I'm on the board of directors, and we're dedicated to providing affordable, compassionate medical care to over 30,000 people in the Tola coastal communities of Nicaragua, which is the second poorest country in the Western Hemisphere. Now, as a member of the board, I've seen firsthand, and so has my family, the profound impact the clinic has on lives, providing things we all take for granted: primary care, pediatric care, urgent care, and just general wellness services. Here's what I want to make clear is that this organization is having a tremendous impact in the local community, as are many others that are always clamoring for your time and attention. But this one's near and dear to my heart and has been so for over 20 years, especially because they saved the life of one of my colleagues when we pulled him out of the water in a freak surfing accident. If it wasn't for the clinic, he would no longer be with us. And that's just one example of the work the clinic is doing. I just encourage you to take a minute to learn more about the clinic, how you might be able to help if you feel so led. So visit nicaclinic.org or scan the QR code on your screen. And if nothing else, I appreciate your time and attention for checking it out. We'll be right back with our first guest after this.
Basenese joins us now. Lou, great to see you. Look, the S&P is close to another high, same with the NASDAQ. But some of our guests have said, look, the market is overly reliant on the Magnificent Seven. Would you agree with that?
I wouldn't. Color me the contrarian here.
I will.
For good reason, too. The Mag 7 keep expanding earnings way faster than anyone anticipates.
Yeah.
So last quarter, it was 27% earnings growth versus estimates for 14%. This quarter, 25.7%. So as long as these companies can keep growing their earnings, it'll bring the valuations back in line. The stock prices will go up. Stocks always follow earnings. I think this is a misnomer here, right? You got the hot hand. These are your all-star players, right. The Mag 7. You don't take the ball out of their hand. You keep giving it to them. You keep giving it to Caitlin Clark. You keep giving it to LeBron James. You keep giving it to Aaron Judge. You don't say, no, give me that back. Go sit on the bench. So.
Love the sports analogies. All right. A new Bank of America poll says that 45% of investors say that the Mag 7 was the most crowded trade.
Yeah, it is definitely the most crowded trade, but it's the one that's working, right?
Right.
The earnings are there. It's driving it. You don't want to miss out. I think, though, you have to diversify out of the Mag 7.
Yeah.
Not completely, but you got to have positions in other companies. There's still value in this market. If you look at the energy sector, trading at about 15 times earnings. There's even chip companies like Alphabet trading at 19 times forward earnings. So, you have NVIDIA at 40 times. You can get something half price. That's a player in AI. I think that's a pretty good opportunity in a market that's...
Welcome back to the Big Skinny, and this is the time of the show where we live out our be humble or be humbled in the markets motto, because we know we don't know it all. And that's why we always try and bring you compelling guests that can help level us up in areas of the market where we need it, or just give us unique insights. And today I'm pleased to introduce you to a young man that I met not long ago that is all in on crypto. Welcome to the Big Skinny for your first and hopefully not even close to your last appearance, Cade Bergmann from Wolf Bitcoin. Glad to have you here, my friend. Well, listen, I'm going to jump right into it because I've been reading some of your recent tweets, and I believe we're of the same conviction here that the crypto world is really consolidating around Bitcoin. Do you agree with that? And what does that mean for Bitcoin's price, even though we're sitting here, relatively close within spitting distance of all-time highs?
Yeah, I would definitely say for the last year, and honestly, up until very recently, I don't even think an altcoin even crept in my brain for a few months there. I completely forgot some of them existed actually because it's been all Bitcoin led, and it's certainly from the institutions as well. All of them came flooding in, and we were like, okay, great, all this momentum, this volume, retail's coming in. They're coming in. They're going to grab some of these small caps. I know you're loving those, and so people were like, they're going to come. Of course they are. But then the
Yeah.
attention and money actually ended up just flowing into Bitcoin, and then slowly over the last few months, more and more news comes out. Trump is saying, hey, we're buying Ethereum. We have Trump's son saying, buying Ethereum. And everyone's like, I don't know, this chart's not really showing like it's got any strength, that this is going to be a Bitcoin-led rally. And then in the last few months, we started to see them start to rally and see some outperformance against Bitcoin, actually. And so that's been actually really fascinating. But from an institutional perspective, I do still believe, and that's why we actually rebranded from Wolf Crypto to Wolf Bitcoin, that it is going to continue to be Bitcoin-led because there are some fundamentals around Bitcoin as an asset that I believe set it apart from the rest of the industry.
So what are those? Because look, I agree. If I look at the crypto strategy thing, I think everything is going to trade eventually. That digital asset treasury strategy is going to be everything trades towards a 1 times MNAV around Bitcoin because it's going to be the most liquid, most in demand. But you tell us, because I'm a crypto neophyte here. I know next to nothing. What are the fundamentals that lead you to believe Bitcoin is going to be the main consolidation play for crypto?
Yeah, so honestly, with this, to keep it just keep it high level with Bitcoin, the biggest argument you see from a lot of the crypto tokens out there, and it's tough to make the argument because there is some tech out there that's pretty compelling. The issue is when you bring in and introduce a token into the ecosystem, and then all the attention becomes about the play. Is this going to go up? Is it going to go down? It becomes a speculative game. With Bitcoin, it's still like that because, of course, it's an asset. People are speculating on the price. But there are some fundamental characteristics of Bitcoin that got me to think, why are all these billionaires dumping irrational amounts of their net worth? But not into Ethereum or Solana, but just into Bitcoin. There must be a factor in here that I'm missing. And that's when I started to poke in a little bit. Some of the easy ones. Some people are going to have heard this a million times. Some people are going to hear it for the first time in regards to Bitcoin, but there is a limited supply. So basically what you're seeing is Bitcoin being priced in at like $120,000 or something as this piece of tech, this asset that is sort of fundamentally representing a bit of freedom money. It is a money that kind of started out of nowhere. It was kind of this thing that was sort of against the culture. And then over time, the price just kept going up and people were saying, why? And the more people that found out and learned about Bitcoin say, hey, there's limited supply here. Hey, you can't just print more of this like another asset we all are aware of. There's actually something really compelling about sound money into the conversation that we could probably talk about with Bitcoin. And over the years, it went from a little bit of a joke to the point where now it's like, okay, how long can you keep not really taking it seriously? At what price point does Bitcoin need to get to where you're like, okay, maybe this needs to be a conversation we have, because I really haven't seen it happen up until the last couple of years of people discussing currencies and calling into question the dollar, really up until Bitcoin started to trend into this 6-digit territory.
Yeah, no, I agree with you. I mean, if we go back to the great China boom back in the early 2000s, where everyone was saying that the yuan or the renminbi was going to replace the dollar as the reserve currency, that was never going to happen. But that was when those conversations started. And I think you're right. This adoption, I think we featured, Tom Lee had a quote saying, like, never in the history of the world has an asset grown to 2 trillion in market cap and then suddenly disappeared. So what is fundamentally better for Bitcoin to be that digital currency, reserve currency versus Ethereum? Is it simply a difference in the supply? Is it a difference in the speed of the blockchain underlying it? What are the pros and cons if someone's looking at this from Bitcoin versus Ethereum? Or is it more of a case as an investor, you go, you need to own some of both because there are pros and cons for each and you're just not sure?
Yeah, I would say ultimately it depends on what kind of investor you are. I had just had a conversation with one of my family friends, and we kind of dove into the conversation around Bitcoin and Ethereum. And at the end of it, he was like, okay, I can kind of see the difference here of assets, but I don't really understand Bitcoin. I don't really fundamentally agree that maybe this is helping society in the way that I like to put my money in for investing. And he was like, so even though I understand it and I even agree in some ways, I'm not really gonna put my money here. So I understand that from an investing perspective. But when you're pairing up Bitcoin and Ethereum, there's one fundamental characteristic that I think is probably the most top of line. For the crypto folks, they probably have heard a million times, but to the stock investors, it's probably worth hearing again, is the proof of work nature. Ethereum ended up moving from proof of work to proof of stake in the last few years, which was huge for crypto, and everyone was super excited in the beginning. I remember, this is so great. It's going to be faster. There's all these things that happen because you're proof of stake. But then there was another conversation, which is, what are you leaving behind by becoming now proof of stake and leaving behind proof of work?
So I got to back
the
you up here,
currency.
because when you say proof of stake, I'm thinking of like my dinner at Del Frisco's last night,
Yeah,
the steak in front of me. So explain, and I know there's probably other people here. So explain in simple terms for us newbies, proof of work versus proof of stake in a way that's a fourth grader could get it.
Of course. So proof of stake. So essentially, with the currency conversation, how I'd mentioned, it's relatively easy to print more dollars into the system. It seems too easy. And with a lot of these currencies, those are kind of the main things people are worried about. And that is the main thing that proof of work is there to stop. And there's about these Bitcoin halvings, where every few years it gets harder to mine Bitcoin. And so that's the whole conversation around proof of work. It's just like, hey, there's a new currency, there's more coming out, but it actually takes a considerable amount of work, money and effort and electricity to make it happen. Versus proof of stake, there's some things you can spin up and make happen that I always can't account for. It gets a little bit uncomfortable for me. So if I was going to put my money into an asset and say, hey, in 200 years, this isn't going to change. This code is here. This is set. This is something I can believe in long term. That's where I would put my money into Bitcoin before I put it into any other altcoin, really.
So the proof of work, in grossly simplified terms, is more believable, transparent, and trustworthy than a proof of stake system, because the costs are going up. There's more validation that's going to. Is that oversimplified too much?
Yeah, I mean,
Yeah.
From an oversimplified way, you can walk away with that, yes. And it also just makes sense long term. If you're going to keep this thing sustainable as an asset that people are going to be using, if you want it to be something like digital gold, I think there are different ways you could use the other currencies, but I think for Bitcoin, it's the most compelling. For me, it's the only one that I could probably say for the next 100 years I know will be here. Every other crypto, it's just a little bit more in the air. It's just harder to know.
Yeah, I mean, a lot of those altcoins as well. On a previous episode, we did crypto or crap, and there's some crazy ones out there. So I don't think they'll be around in 100 years. Here's a question for you. So all that in mind of Bitcoin, Ethereum, and these other coins, how do you invest? I mean, you had a recent tweet, which I love, by the way. I've always been a high conviction, low number of investment investor that you got to go all in with conviction, forget diversification to create wealth. I mean, what brought you to that realization? And does that mean you're all in on Bitcoin and nothing else? Or, if you don't want to share that, no worries. How would you approach it?
Sure. So that was for me a bit of a rolling realization, I guess, over the last year or so. And like last year and a half, I had grown into this position of Wolf Crypto, now Wolf Bitcoin. And from every aspect of my life, I noticed every big jump required a big leap of faith. And after the leap of faith, it required all in for a little while, a lot of pain for a little while. And then, usually at the end of it, something would come from it. But I very rarely found that life changes came from diversifying anything. And so even when I was looking into conversation of like, where do I put my money? I'm a bit older now, I'm 26. The conversation around money is different. It's not, can I buy this watch tomorrow? It's like, hey, can I take care of a family? Because that is kind of my priority. And so because of that, my focus has changed with my investing as well. I'm like, where am I going to put my money? Where do I feel safe having worked and earned all this money to put it into something that I feel good about and believe in? For me, that's been Bitcoin. And slowly that went from a 20% stake to 40%, 70%. And now I'm sitting around 90%, which feels pretty insane. But it feels right. And that's kind of where I'm at right now. So we will see how it all ends up playing out. I will say I'm 26. So in my head, if it all goes wrong, I'll pick up the pieces and start again tomorrow.
Hey, listen, man, I love nothing ventured, nothing gained. I can tell you at not 26, at closer to 48, some of my best wealth generating ideas have been when I've been 50, 60, 70% concentrated in a single investment. And look, this came out. We've got a question here from you from Nightlight Video. Ether, Solana, and others have other use cases that are valuable beyond Bitcoin that would scale the crypto ecosystem. So how do you answer a question like that? There's other ones that have use cases that might be more limited but helpful. Does that mean the world can coexist with multiple cryptos, or how do you view that? Answer this question.
Realistically, probably, yeah, they will probably be multiple that exist. I think for me, the most compelling argument for Bitcoin is it was the first. It came because of the 2008 crash. That's where it came from. The other ones, it's hard to know really why they were started. Maybe it was truly there was a tech opportunity. But as soon as the currencies got introduced and the tokens became introduced, it really muddied up the waters there. So I would say, yes, there probably is some good use cases. Unfortunately, I don't know if that always plays a part and matters almost when you're factoring in the price of a lot of these tokens. It's hard to know where the value comes from.
Yeah. No, it's a fair point. Listen, man, we've got another guest we got to get to, but I want to make sure you're willing to come back because I know your depth and understanding here goes a lot deeper. I just want to introduce our audience again to getting used to crypto. Another compelling case here. Encourage everyone. You can learn way more from Cade at 26 wise years old than you can from old Lou Basenese here at 47. Follow him on socials at Wolf Bitcoin and Cade Bergmann. I think you got a YouTube channel too. There's going to be more content that you can consume. And Cade, would love to have you back soon.
We'd love to come back. Thank you so much, Lou.
All right, man. Thanks for your time. We're going to roll right into our next guest and keep this crypto theme alive. David Nicholas is the founder of Nicholas Wealth Management, and we've crossed the airwaves plenty of times on Fox Business, a couple times on Fox News, I believe. But what really caught my eye a couple weeks ago is when I was on a Spaces with him, and we were talking about an innovative ETF that he recently launched that pays you weekly income by being leveraged to digital currencies and emerging technologies. So without further ado, I'd love to welcome David. Good to see you, my friend.
Show. What a great, I've enjoyed it the short time I've been on so far listening to it.
Listen, the roles are reversed now. I paid you to say nice things about me when I said them about you on the Spaces.
Man, you know, and I tell you what, if I could look that good in a t-shirt, I'd be wearing one right now. But you're looking good. You sound good, man. So I'm excited to be on.
I appreciate it. Listen, man, I want to get to this. How do you come around? Because you've been in the markets for a while, like me. I don't want to say a long while. We're not that old. You've seen things come and go. You have a great understanding of trends and how to make your clients money through all market cycles. And then you come up with a really innovative idea. And so tell us about the Box Fund and what's at its core and how it came about.
Yeah, so you know, I appreciate the question on it. You're right. We've seen so many different cycles as investors, as managers. So for me, it was really obviously crypto is becoming something that is only gaining in popularity. We've seen the use case from blockchain to Bitcoin to Ethereum. We've seen the rise here in the last couple of years. We had more and more clients come to us asking us about crypto. And the interesting thing is, you know, the SEC, as we know, pretty much had our hands tied as managers and as financial advisors. We'd have clients come to us, hey, David, I want to buy crypto. We had nothing to offer them. So if you think really, it was only last summer that the SEC approved Bitcoin to be inside of ETFs. Really up until that, as an institutional manager, as a financial advisor, we really had to stay away from it. And so the SEC approving Bitcoin in an ETF really was the first thing that really unlocked the ability for us to start looking at this. And so when I looked at Bitcoin, I said, you know what, I want exposure to Bitcoin. But again, you know, if you remember Warren Buffett, the times that he's spoken on it, even Charlie Munger, they just had this distaste in their mouth with crypto.
Yeah, they did.
It just didn't fit inside of their square peg block of earnings and growth. And so,
well, neither did Apple until Apple did for Buffett and made him maybe a couple billion more on his net worth.
Hey, no shade on the vote, but he may have missed a little bit on Bitcoin here.
Yeah. So so now the SEC clears a path for your clients to own crypto, right?
Yep.
Most advisors go, let me go find an ETF that I can buy for them. You go, no, let me create an ETF. So this ETF, I think, is interesting because it doesn't own directly any cryptocurrencies, but it owns companies that are involved in the crypto space. Talk to me about that. The X Fund, we're putting up the QR code here on the screen so people can get more information, but talk to me about the strategy here and how it's working to generate weekly income on an asset that people don't think generally associate with a dividend or a yield.
Yeah, that's right. So blocks, the whole idea is we want to own the whole crypto universe. So we have exposure to both Bitcoin and Ether. So about 40% of the fund is Bitcoin ETFs. So we're going to get a 40% allocation that is going to provide price exposure to Bitcoin. We've got a 10% exposure to Ether. So if you think of it, there's three components to the fund. You've got the crypto sleeve, which is 50% of the fund, which is directly Bitcoin and Ether. The other 50%, right, is 11 companies that all have exposure. They're not all crypto companies, but they benefit from the price of crypto increasing. So those are going to be the custodians like Hood and Robinhood, and you've got a few other custodians there. You've got the miners like Riot, Mara. You've got the chip makers like NVIDIA, Taiwan Semi. So again, it's owning the whole universe of Coinbase and Hood, right? Of what are the sectors and names that are actually going to benefit from crypto doing well? And so again, going back to that Warren Buffett idea, we've got real earnings. we've got real revenue growth, we've got companies that are actually producing a profit, and we marry that with actual direct exposure through ETFs, through to Bitcoin and Ether. But then the unique thing that we're doing, Lou, is we're doing an option overlay. And so there's a whole universe of these income producing funds out there, and a lot of them sell covered calls. We're doing it a little bit unique. We're actually selling puts. And so with that, for our options guys, if you're selling puts, you're getting all the appreciation on the stock, but you're also getting the income of the put as well. So the equities, we're currently selling puts, but on the crypto, we're selling calls, and we're doing call spreads. So it's almost like you've got a little call.
So you have a position in NVIDIA, but then you're still selling puts against it, saying like, I'm willing to buy more if it comes down here. If not, I'll just collect the income off of it.
That's exactly right. Well, and we won't necessarily buy more. We're actually doing a spread as well. So we'll sell a put and then buy another put to cover us as well. So if the stock goes down, we can buy more if we want to, but we're not tied to doing that.
Yeah, no, I love this for two ways. You're giving people, everyday people, Main Street investors, access to a very sophisticated strategy. In a way that encompasses two compelling trends, right? You have your crypto sleeve, but then also these names that are doing very well that are crypto adjacent, and that you can do traditional income generating option strategies. The other thing I love is you're creating new content for me, because now in future shows, I'm going to have to explain the difference between put selling, call buying, spreads. And I think there's a gap in I know. Good luck is right. But I think there's a gap in the market there. So what is the biggest objection you get from people that are looking at your fund saying like, I don't really understand it? Or what are the common, benefits that you're hearing them after the fact once they get invested?
Yeah, so and Lou, I don't know if you've looked into this much, but there's not a lot of people covering it. There's a whole world out there of these income funds. And so I think there's a lot of disconnect between, am I buying this fund for income, so that is the NAV going to stay flat or go down? I'm just getting income, or am I buying it for growth? The objective of our fund is first growth, then income, but we are distributing 36% yield. So here's the other little point out to that is, as Bitcoin becomes more of a commonplace household asset, we would expect the standard deviation to go down, which is a good thing, right? We want Bitcoin to be less
volatile, and it's more stable, like we'd hope as it gets more
exactly. But if we're option sellers, that actually works against us. We want vol. So, which is why though, on names like Mara, in names like Riot, in names like Coinbase, the standard deviation is so much higher relative to Bitcoin that we get more premium for that. But I don't want to cap my upside. So that's why selling puts, I think, is a great way where you get income, you get upside. I just think it's letting investors understanding the why this fund was built is to capture both growth and income as well.
Yeah, no. What else do you have in your pocket that you're looking at doing? Because you're always an innovator. So I want people to take a look at this ETF. You also have another ETF, I believe, as well, or two other ones. So tell us about those so that we can understand. I've made the argument that there's an explosion in active ETFs, but true to form, there's always a lot more garbage than there's good. So we're trying to sift out the good, unique strategies, which I think you've cornered. But tell us about the other two ETFs you have.
Yeah, so we've got two other ETFs. Well, I'll start with our global equity income ETF. So this is I looked at the marketplace. There really wasn't a global fund that had international exposure that also did call writing as well, or options income writing. So GIX is our Nicholas Global Equity Income ETF. It doesn't mean international. It just means we can go across the globe and allocate really where we think is going to make the most sense or provide the most value for investors. So if you look at the holdings of GIX, I mean, we've got Vanguard, S&P. We added back small caps. I was a little early on the small cap trade, but as of last Thursday.
Welcome to the early party. I got the first party favor there in the hat. I'm the one handing them all out. I'm thankful that anyone else is showing up. So
yeah, we had mid cap. We kept our mid cap exposure on the entire time. We yanked small caps in January of this year. We just added it back. So if that says anything to investors that are looking where to allocate capital, we are bullish on small caps. We have emerging markets. We have Israel. We have Europe. We have Argentina. We reduced our exposure to India. But this is a global ETF. We're beating the S&P year to date, and we're also providing a yield of 24%. So to me, we're not so rigid that we're only domestic U.S. or we're only small cap. We're global, so we can invest.
You're global
classes. Yeah.
Well, listen, man, we're running out of time, but I want to encourage people. I want to put the graphic back up on the screen here and encourage them to go check out your website. You can read about all three ETFs that David and his team have spearheaded here. It's at the X Funds by Nicholas Wealth. I'd love to have you back on the show, but I'm going to wait until small caps kick butt and we can take a victory lap for being right finally after being wrong. So
finally,
thanks. Awesome. Thanks again for joining, David, and talk to you soon, brother.
Thanks for having me, Lou.
All right, folks, we're going to take a quick break. Man, I had a coffee before. I think it had too much caffeine in it because I am just like micro machine Mike speaking way too fast. Slow it down, Lou. Slow it down. All right, that's my in-show pep talk to myself. Before I remind you to go to thebigskinny.com to sign up for our newsletter or scan the QR code on your screen so that you don't miss any more market moving insights without my blabbering word struggling to find mouth today. So with that, we're going to be back right in a second with a good friend of mine, Kenny Polcari. But don't forget to join the conversation, change the direction of this show if you choose or dare. We'll be right back to you real soon. Attention investors, are you looking for a high growth opportunity in the energy sector? Well, look no further than Prairie Operating Co. trading on the NASDAQ under the ticker PROP. As America's premier high-growth, low-cost oil producer, Prairie is making waves in the DJ Basin in Colorado. With a recent transformative acquisition, the company's expanded its footprint to over 55,000 net acres and increased daily production by over 20,000 barrels of oil equivalent. Prairie is poised for strong growth, maintaining a conservative balance sheet while delivering value to shareholders. Don't miss out on this exciting investment opportunity. Prairie Operating Co., PROP, on the NASDAQ. Full disclosure, I am an executive at the company and deeply conflicted and own shares. Also, past performance does not guarantee future results, so consult your financial advisor before investing in Prairie or any other company or investment that we discuss on the show. We'll be right back.
Are you a fan of this?
I am, and we've talked about this. The AI race
You're
is
a fan. You like the fact that 15% is going to go to the U.S. Treasury in order to get into China.
That's unorthodox. I'm a fan of abundance. You share technological innovation because it spurs on more technological innovation. And if someone's going to make money off of it, I would rather it be U.S. companies. Now, this is completely unorthodox for President Trump to announce this deal where they have to pay a 15% basically tax. But think about it. NVIDIA last quarter said they lost out on $5 billion worth of sales because they couldn't sell their chips. So would you rather have 100% of zero or 85% of $5 billion? So I think from an economic standpoint, it makes sense to them. I also think it's interesting as well because people are a little bit impatient now. They're talking about this being the forever trade war. But if you look historically, most trade deals take 18 months on average to get done and 45 months to implement. So I think the markets are reacting appropriately about the extension. Like, okay, it's moving, it's progressing, there's nothing to get worried about. I think what was unconventional was we've always had outstanding trade wars with maybe one or two countries at a time, not 90 all at once. So I think it's a positive for the market, but I also think it's a positive here for NVIDIA and AMD. That they're going to be able to sell lesser technology, but still generate the revenue that they can reinvest in the next great invention.
Well, folks, it's that time in the Big Skinny history where for the second time, we're checking in on what's cooking with Kenny Polcari, Chief Market Strategist at SlateStone Wealth. Let's see if we got him belly rolling, laughing with that image like we did the first time. Success! We win! I'm not out of my mind. Listen, my friend, it is always a pleasure to have you join the show. It's always a pleasure when I see you on the airwaves on Fox Business as well. But I wanted to check in and just take your temperature, man. My feeling is that everyone is freaking out about the market hitting all-time highs, about big tech taking up so much of the S&P 500. Wow. Cry me a river. Are you scared about this? Am I an idiot for being so nonchalant?
No, I'm not scared about it. I'm not afraid of it. But the position I'm at is let's just slow down. I think it's extended. I think it's due for a pullback, which doesn't mean you can't take money and allocate it to other parts of the market that have not been outperforming, right? So I'm not afraid of it. I'd buy more on a pullback, but I'm certainly not chasing it up here.
So, I mean, I think this is an important perspective too, because you were on the floor as a market maker, trader. I mean, through probably some of the most historic ups and downs in the market. I mean, does this smell anything like it did to you during the dot-com days, right? Because everyone's making a big stink about prices and valuations, but is anything similar to you?
No, it's not, because you have to remember, during the dot-com bubble, those companies that had .com in their name had no earnings, they had no history, they had no nothing. It was just about the excitement. The internet was going to change the world, and all these companies put .com after their name, and suddenly their valuations exploded because people just got so caught up in the like the FOMO trade. Oh my God, I have to get in. And so this is nothing like that. These companies that are taking us to new heights are real businesses with real earnings and real history and real margins, and it's Palantir, it's Nvidia, it's AMD, it's all the big names, right? It's Apple, it's Amazon, all really solid mega cap names with history that's taking us too high. It is completely different than what it was in 1999.
I completely agree. So I'm glad to hear that validation from you as someone that was on the floor and probably felt the pandemonium probably more than anyone else. As you look at it though, so where are you finding opportunities in this market, right? You said you feel like it's overstretched. So where does that lead you to, if you're putting new money to work, what's really compelling right now?
So it's the areas that have been clearly underperforming and that are selling off their highs. So if you look at financials, those are off their highs. You look at energy, off its highs. Consumer staples, boring, yes, but they're off their highs. And if the market gets a little bit anxious,
Wait, come on, dude. You're
consumer
not
staples where you want
consumer
to be.
staples? Consumer
Consumer
staples is like a
staples, Procter and Gamble, 100%. Procter and Gamble, big boring names like that. They're good dividend payers. And in a down market, if you're worried about the market really getting crushed, remember, you still need to go out and buy toothpaste and soap and toilet paper. That's what consumer staples is, right?
Yeah, but that's like so
I'm not
defensive.
necessarily saying that you allocate a big portion, but you're asking me where I'm finding opportunity. Also, clearly in healthcare, look what happened in healthcare. Not just a UNH thing that ignited this massive rally in UNH on Friday and took the whole sector with it. But if you look at names like Merck was down 20% year to date, right? It was building a base there at 80. It paid you a 4% dividend, and it's been way underperforming not only the market, it's been underperforming its sector as well. It's a name that we own. It's a big mega cap name in the space. It's a name that I like. So those are the places. Now listen, don't go poo-pooing me on consumer staples. I get it. They're not sexy. I get it.
Yeah. No, look,
But
I can get behind
I think
the
there's a
healthcare.
place if you're anxious about the market, I think there's a place for consumer staples.
Yeah, no, look, I mean, I just didn't pick you as the guy that was going to pick, diapers and toilet
Oh,
paper and canned goods.
but remember
Uh,
my role as a wealth advisor, I have to think
I do.
about the total picture for these clients. I got to think about building portfolios that can weather the storm. Now, I'm not necessarily running right out for myself, but when you talk about building a portfolio and having a well-balanced and diverse portfolio, you have to consider allocating some of it to consumer staples.
No, and I agree. Look, I'm surprised a little bit because you saw staples really rally the sector as a whole earlier in the year. Obviously, when we had concerns, then we had the tariff tantrum sell off. You saw good
Correct.
performance and a rotation out of it. So I'm not poo-pooing that. I think in a holistic portfolio, you got to have exposure. It's definitely out of favor and creating opportunities and has a stabilizing effect. I think for me, I'm more opportunistic. So I love hearing you get bullish on Merck, a name that I think has one of the
Yep.
top selling, if not the top selling drug ever made. Again, Keytruda, you're seeing that they have plenty of stuff in the pipeline that can justify a lot more growth. So,
Right.
what do you think
It's
in the
been,
end?
it's been getting killed, right? It's down 20%. The sector was down before this recent rally. The sector was down about 8%. That was down 20%, way underperforming even the broader market, right? The S&P is up 9.6% as of tonight, right? The
Yeah.
Nasdaq
So
12%.
here's the last question. It's two-parter, right? I'm no longer in the camp that the Fed shouldn't cut. You and I both were in there. Are you still in the camp that Powell should hold rates, where they
Well,
are? And if he cuts them, what does that mean? Like where the opportunities materialize because of that? Is it financials that's the biggest beneficiary? Where are we at?
okay, so it's funny because you know me, I was in the camp that they shouldn't cut. I think by holding rates here, they were going to put pressure on housing, and you're actually starting to see housing in parts of the country really start to pull back in, which is actually a positive thing because you got to have some retreat in housing prices. If they start cutting rates, and look, a 25 basis point cut is not going to send mortgages down from 7% to 5%. That's not going to happen.
Agree.
So that's okay. But I do think now after the PPI report, which was much harder than expected. It wasn't a 1/10 of a percent greater. It was 0.7% greater. I think it goes to Powell's point is that these producers have been kind of eating those higher prices, just waiting to see where the markets, where this whole tariff thing is going to end up, and when they should start passing it on. So I think he's been right in dragging his feet and being slow. Now, that being said, you got kind of a slowdown in the labor market, so it's a tightrope that he has to walk. Is he going to pay more attention to the labor market, or is he going to pay more attention to inflation? I think 2% is now 3%. I think that's going to be the level that they're going to accept as a level of inflation. And if that's the case, then a 25 basis point cut by the Fed in September, I don't think is unreasonable. And I think instead of what I thought was it then going to be 100 basis points between September and December, because I thought there was going to be 50 in September and then 25 and 25, I think that's off the table. I think they're lucky if they get 50, 125 in September and the other 25 in December, and they'll give October and November a chance to kind of regroup to see what happens.
So I completely agree with you. We both changed our mind on that based upon the data. I guess my fear is that Powell is not as just-in-time perfect cook like you are, and he's going to leave the pasta in the pot for too long, and it's not going to come out al dente.
Then it gets
It's going to come out
mushy.
overcooked.
Gets mushy.
Yeah. So we got a question here from Chad Towers. If and when we cut housing financials, but how about oil field services? Halliburton, any other names that you like in oil on an interest rate?
I like energy, so I like oil field services. I like anything in the energy sector, especially let's not kid ourselves. I like what's going on in the nuclear space, right? So names like NuScale, some Duke Energy, a lot of these utility companies that are now jumping on that small nuclear reactor wave, right? And you can see it. Look at utilities up there, up 12.5% this year, the most boring sector in the world. And it's one of the outperformers, clearly because of the demand on energy. So yes, anything in the energy space, in the oil sector and services, I certainly like. Schlumberger is a perfect example of a name that I like. We own it. I like it. And I think, big names. Exxon, Chevron are big mega cap names in the space. It's a good place to hide out. They pay a decent dividend. You're not going to get whacked in those names because they're so big and liquid.
Well, listen, man, I always appreciate your insights, and I appreciate more than anything your candor, right? You're like me. We got to be able to change our mind when the markets change on us. So I love that. I look forward to the next time we talk and see what else has changed and figure out what's cooking with Kenny. Next time I want you to bring a recipe, my friend. Yeah, a good cannoli recipe, maybe. So
listen, I'm happy to bring you a recipe whenever you want it.
All right. My friend, it is always a pleasure to see you. Look forward to seeing you again soon.
See you. Bye-bye.
All right, folks, we're rounding out this show with 3 powerhouse guests. I mean, I just love this. I love being able to get the insights and the wisdom from people where it's just not possible for one person to do all these things. If you think you can stay on top of the markets alone and figure this out on your own, you're sorely mistaken, and you're going to learn the hard way by losing money. So I hope you appreciated the insights from Kenny, Cade, and David. We got more coming at you before the end of this show with the Dodd Man and our high five. But before we get to that, please remember to sign up for our newsletter at thebigskinny.com or scan the QR code on your screen. And don't forget to share and in the comments in this show and jump right in. In fact, we're just going to jump right into the next segment and go to Dodd, because who needs a break when we're just rocking and rolling? Dodd Van, welcome back to the show, my friend.
Hey, Lou. Yeah, I got to say, David's specifically, but all the guests today, there's a lot of information. You pointed it out. The thing I was thinking is there's going to have to be some education coming up. There's puts, there's a lot of those, a lot of things going on that I think,
Yeah, and
I could use some. I mean, we can explain some education on, So.
Yeah, no. And Vanessa Michelle saying, great show. Thanks so much. Thank you, Vanessa. We got more to come. Chad, more to come. Let us know, especially the viewers here that have always been loyal to pop in with questions. What are topics that you'd love to learn more about? What are educational pieces that you want to understand, aspects of the market that you want to understand more about? There's no dumb questions in this world because we all start somewhere and you got to get started. That's the most important thing. So we're happy to help along that journey. So just let us know. I'm in Denver. My question, those are 21 and 15 of my percent of my portfolio. Those are big allocations. So like, this is a great piece that we should probably talk about is portfolio allocation, position sizing in a future episode. I mentioned that I run highly concentrated portfolios historically. That's not for everyone. I think you need to strategically rebalance on companies that have run higher. Use something like a trailing stop that doesn't make your sell decision emotional. It takes it out. So we'll go over that. But Chad, look, if you know what you own, and I know you from past comments, you do your work, you've dug into them, and you feel comfortable, and you're sleeping okay at night, and you've got an exit strategy, like a trailing stop in place, then yeah, you got to let your winners run. But I will tell you this, what I've learned, when I wake up at night worrying about one of my positions, worrying if the next earnings is going to be on, if the macro event could sabotage it, it means I probably own too much. You should wake up and sell some the next day. So appreciate your comments though, Chad. We're going to get to 5 topics here that, Dodd, I don't know that everyone knows. I spring these on you to see if you have any clue what I'm talking about, to keep it fun and interesting. So I don't want people thinking that you've got a preview of what we're going to talk about here.
It's always fun to guess what's coming next, Lou. Well, first and foremost, and we ask this each time, do you think you're going to know them all this time?
Yeah, I got him this time. I got him down this time. I'm feeling confident. Right. I can't get words out of my mouth, but I can remember pictures today.
All right, let's get to the high five.
All right. We are high-fiving into the end of the episode.
As you say, Lou, there's some of these that I'm just like taking a full swing at because no clue. But some of them I might have a handle on. I don't know. We'll see. But don't deflate me, bro. I said the football to Tom Brady. That's all I got for that one. Didn't leave a lot to guess at.
I would love that because I'm a New York Giants fan and we have a way to win against Brady. We don't have a way to win any other times. But no, this was after the Don't Tase Me, Bro. Remember that great school, the University of Florida, that had that viral YouTube clip where the kid
said we weren't going to talk about that anymore.
Yeah, well, I break the rules all the time. Now, listen, I'm bringing it back to college because if you look at the unemployment trend right now among recent college graduates, AI is really wreaking havoc, and it's making the news waves here about how much the unemployment rate is going up in this age demographic here. And my initial response is the unsympathetic one. Sorry, I grew up in a different time. You don't have a job right out of school, cry me a river and work harder to find one. And I say that lovingly because that's what I had to endure. I graduated in 2000. You know that the markets peaked in March of 2000, the nasty .com bubble that we talked about. It was not the easiest time to find a job. It took me until October, and I literally begged, borrowed, pleaded with everyone I could that had a job. I don't care what it is. I'll do it. I'll find a way to make an opportunity out of this, and got into the most boring, unexciting, you name it, tedious industry ever, insurance and reinsurance, but it was a job. So yeah, I know.
Exciting.
I know.
Now, do you still think AI is not taking jobs?
I think AI is not taking jobs, but people that know how to use AI are taking the job that you want. I think we talked about this in previous episodes. AI, every big tech innovation, yes, removes certain jobs, but then also creates new jobs that were never previously possible. So I think you're going to see that happen here. Yeah, some of this entry-level things are going to go away. They're going to go to AI, but then guess what that requires? The creation of, and it opens up new jobs, but it also requires the education system to be reformed, to actually train kids when they come out of college to find new jobs. And here's another thing. There's no competition. I mean, you have 2 choices. Learn to adapt to AI and use it in a career path that you can be, use that tool. It's a new tool in the toolbox. Or go to an AI-proof job, like a trade skill, like a diesel mechanic. You can make great salaries there, not take on hundreds of thousands of dollars of debt, and start earning money, and you're not subject to any AI disruption. So that's my advice to any youngins here that are thinking about maybe college or coming out of college and not sure what to do. Look, work hard, try hard, keep your eyes open, get a start anywhere, like all of us did, and you'll find your way. Because what were you doing when you were 22, recent college graduate? Like, are you in the same job now?
Right now?
Yeah, not probably not. We don't have enough time for that. Let's keep moving along. BLS BS.
BLS BS sounds like a K-pop boy band for sure, but I'm going to guess that this has something to do with the gross incompetence of the most recent jobs report.
You are spot on, man. The Bureau of Labor Statistics, if we look at this chart here, you don't need to be able to read the fine print. All you got to see is the up and down variance. And this is basically evaluating every report, the initial estimate and the change from the initial estimate to the final estimate. I mean, this is less accurate than every weatherman and weatherwoman in the world. It's completely unreliable. I always argue that even a noisy signal, right, has some signal in it, right? And that you can discern something valuable from the trajectory. I can't make heads or tails of that. So I think it makes the report completely unreliable, which is why the president fired the head of the BLS and replaced him with EJ Antoni, who has to get confirmed still, I believe. But he's someone that I've been across the TV with, and very constructive. I think he reluctantly took this job because had he turned down a job in the White House, right, in the administration, but he knows the challenge ahead of him to get this data reliable. So hopefully we'll get to a point where this never happens again.
Well, here's to hoping, I guess. Okay, Golden Apple. Obviously, I wouldn't expect you to put up anything up that says like rotten apples or something, because I know it's got to be one of your Apple fanboy moments coming up here.
Yeah,
so what did Apple
we're gonna
do this
fly
time?
through these. These ones are easy because I remember them now, right? Golden Apple. Everyone wants a dog apple. This is the best, most profitable business ever in the existence of the world. So much so that they've bought back over $700 billion worth of their stock, which means they had enough cash from their business to spend that would be equivalent to the size of over 400 companies in the S&P 500. So think about it this way. Apple generates enough money to buy basically the rest of the S&P 500. That's the best business, period. Full stop. No arguments. Moving on.
Okay, Apple. It's electric. Boogie, woogie, woogie.
No, it's electric and it's going nuclear. This is a chart showing the number of nuclear reactors that are going up that are under construction, and conspicuously absent United States. I told you we've been banging on this drum that if we're going to be a leader in AI, we have to be a leader in electricity generation, all forms: nuclear, wind, solar, base load, real ones, nuclear and oil, fossil fuels, all of the above. So just driving that point home so people see that China's kicking our butt, and if we don't start catching up, they're going to own the AI race.
I was going to say it's a little lopsided there, just a wee bit.
Yeah, just a wee bit.
All right, retail takeover. I'm assuming dumb money is getting even smarter here, right?
Well, the smart money would argue that dumb money is getting dumber because options are traditionally considered very risky, very speculative. And if you look here, we're showing the percentage of retail market share in options trading recently has ballooned to over 20%. You'll recall on previous episodes, we talked about retail investors making up upwards of 35 to 36% of stock trading volumes. That's smart money because they've been buying the dip. I would argue that people buying short-term options, it's questionable, right? But this is still indicative of retail investors are here to stay. We're not going away. And I think Wall Street is coming to terms with that. And I think that's nothing but good news for what happens in the markets ahead. I think we might have some comments here in the closing minutes. We started off.
I love comments.
Yeah. Yeah. So what do we got, guys? Vanessa, you should totally do an episode on portfolio allocation. The one time I heard you speak on it previously was life-changing. I'm doing it. I'm going to do it. That's a glowing endorsement. So we'll put it on the calendar. We'll talk about how you allocate a portfolio, how you think about the world and getting a step ahead with your portfolio, and how you do it in a very easy, straightforward way. So done. Thank you.
Great idea.
Oh, all right. This one's for you, Dodd. You're the video creative guy. I'd like you to know how drone companies are fitting into the sectors.
Yeah, that one's for me. Exactly. You got it.
Listen, I think drones are really interesting from a standpoint of commercial versus defense and industrial usage, right? I mean, I was on Yahoo Finance not long ago with a guy that has a private startup company that actually has making artillery to be mounted on the back of trucks to shoot drones out of the sky because they become such a threat in the military on the battlefield, because now you can arm them and you have billions of dollars of aircraft and tanks sitting on the ground that are easy targets. So I think drones are an interesting play. I personally don't have any drone exposure right now. I used to play this field with AeroVironment way back in the day, AV, but I'll add it to the list. We'll look at some drone opportunities in the weeks ahead. So portfolio allocation, compelling drone plays. We got any other questions to round out this list and tell us what we're doing in the coming weeks? Well,
no, but on the drone subject, I just saw a piece the other day where they're using drones to send blood into like way deep out, like 150 miles out into like, into the jungles and whatnot, like within minutes of ordering it. So, drones are, really doing a lot of great things.
Yeah, that last mile, I saw them drop off to some coffee and some candy for Walmart drone delivery too. So chalk that up to
I'm
not
talking
a
blood
great
that are
use.
saving lives, Lou. We're not talking candy and donuts.
Listen, it could have been a diabetic that needed their Skittles right away, and it saved their lives. But listen, I agree with you. Your point is well taken. That last mile of delivery or last miles into areas that you can't otherwise access are being made possible by drones. So we'll look into some opportunities there. Well, that's a wrap for this week's episode from the Mile High City. Chad Towers really appreciates Kenny. We appreciate Kenny too. We appreciate you, Chad, and all of our other viewers. Always coming with great questions, great commentary. We look forward to joining you again back from the home offices studio in Brooklyn next week. Thank you for tuning in to The Big Skinny. I'm Lou Basenese with Dodd and the rest of the crew signing out.